Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Green is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome to the Private Equity Profits Podcast. I'm Cliff Locks, your host, and with me today is Martin Saenz, managing partner of BeQuest Funds and a best-selling author. Martin brings social good into smart investing, renowned as a thought leader in the mortgage note investment industry throughout an extensive and accomplished career. Martin has demonstrated a proven ability to grow asset values, income, knowledge, and not just for his company, but for his investors, borrowers, proteges, and readers as well. Welcome, Martin. Thank you so much for taking time to talk with me. Let's start at the beginning. Tell me how you got started and what attracted you to private equity.
Sure. It kind of all started when I got out of business school with my MBA 2001. So I landed a corporate job in consulting. I was in corporate America for a few years until I got fired. And that was probably the best thing that ever happened to me, because it made me realize that the corporate America was not for me. It wasn't what I thought it was. It never resonated with me. Mm-hmm. So from there, through a series of reading business books and trying to figure out what type of business to launch, I started a small business, which is how most people come into the business community. They launch a small business. For my wife and myself, that small business was a federal government contracting company that provided museum exhibit displays for the federal government nationwide. What I learned from business ownership over the years was that it's brutal and, making payroll the day of, paying bills late, just trying to survive and while working 100-hour weeks it weighs on you. So I didn't find that freedom that I was looking for. So I turned to landlording. And my wife and I, we started accumulating properties in 2008, commercial and residential. What I found with landlording, and we still own the properties and manage them today, but what I found is it's a great annuity play. It's great as you're paying down the mortgages with the rents that are being paid, and you'll ultimately have a property you can sell with seller financing and make all these great creative moves on the back end. But in terms of cash flow that's sustainable, is meet one's financial aspirations, it wasn't there. The connection wasn't made. So from there, in 2013, my wife and I, we sold our company, kept our properties, and I made a decision. I became more spiritual. I became connected with God. I went on a mission to say, I need to create a business opportunity that focuses on servicing others. So enough about chasing the dollar, making XYZ, and having this material possessions. It was just about, let me serve the most amount of people, and something good's going to come as a result of that, financially and otherwise. And so that's how I stumbled upon the mortgage note industry. I started learning about it because I did have a real estate background. So I learned about the mortgage side, which is the flip side of the real estate coin. I started acquiring distressed mortgage notes on properties whereby the borrower had not made a payment in 4 or 5 plus years. These are mortgages, and yes, these mortgages exist more than most people know in the secondary mortgage market space. And I just started acquiring these mortgage loans and learning about how to work them out. I'd say initially, the first lesson I learned is when you buy a mortgage loan that's distressed, the borrower hasn't made the payment, you're exiting two ways. Either you're exiting through the property and you are going through foreclosure, taking possession of the property, or working out a deed in lieu whereby the borrower signs over the property ownership rights to you, or you're exiting through the borrower in the form of a loan modification or reinstatement or a payoff, something to that effect. I learned early on that it was more in line with what my principles were to exit through the borrower, whereby I would work with the borrower and create solutions that help keep them in their homes while making a profit for myself. And that's really how it launched.
I'm proud of you. Non-performing assets are a challenge. REO at the banks. At this point, you're stepping in as a benevolent but business person to help that individual borrower at that point to find a solution, a long-term solution for them and their family at this point. Tell me about BeQuest Funds.
Sure. BeQuest Funds is a 506c Reg D income fund that houses a portfolio of seasoned performing mortgages. Through that, we receive borrower payments in on a monthly basis, and we in turn pay our investors on a monthly basis. So it's an income fund. But prior to explaining BeQuest or even just touching on it, it's really important, I believe, for the audience to understand the roots, like how I worked up to taking on BeQuest and launching that in March of last year. Through the course of the years, I had acquired and personally worked out, whereby I talked to the borrowers, I created loan agreements, I worked out short sales and or discounted payoffs and everything else with over 1,000 loans. So for myself, it's on the fix and flip side. Someone said, well, I fixed and flipped 1,000 homes. So it's really through the course of that growth and really kind of going through and really ironing out my due diligence process. I got to a point, and I'm still a large buyer of distressed paper. Don't get me, like, we purchased 25 million in distressed paper in the past 18 months. So we're still a large buyer of it. With that said, my roots come from helping people that need to be helped stay in their homes while making a profit for myself. Now, BeQuest Funds is on the other side of the fence. We have a portfolio of borrowers that are making their payments on a monthly basis. We only purchase performing mortgages that go into the income fund. So it's more of a management and daily monitoring process so that we can be reactive if we have to do any outreach and connect with folks and help them if they have any special occurrences. That's really what BeQuest Funds is about. So it really touches on the risk side. My background touches on how we mitigate risk on the BeQuest Fund side, because I'm used to the rough side of the fence, so to speak.
Note investing can mean different things. Tell me what it means to you.
Sure. What's important is to talk about the secondary mortgage market space when you're talking about note investing. Someone just pictures a person that wants to go buy a home, become a homeowner, go into a bank or some lending institution, and they apply for a mortgage. And that mortgage application goes through an underwriting process. And from that, a promissory note and a deed of trust or a mortgage is drafted upon approval, of course. And so the promissory note says, I so-and-so, Joe Smith, promised to borrow this money and pay it back given this certain set of terms. And the deed of trust or mortgage is the document that ties that promise to the property in the form of it's a collateral. It's collateralizing that promise. And so what happens is after that mortgage is originated, there's a pool of them that will sit with that originator or will sit with some company they sell it to. And a portion of those loans in the pool will become defaulted. Something happens in a borrower's life that is typically deals with love. A divorce happens, loss of job, underemployment, or health. Those are really what we hear a lot, what we hear most often. So something happens in someone's life, a hiccup, and they stop paying their mortgage. And so what the bank does, or lending institution, they will bundle those defaulted mortgage loans into a tranche and they'll sell it into the secondary mortgage market space, which is similar to a flea market, whereby you have hedge funds and lenders that are buying and selling these distressed mortgage loans. Now, there's also performing mortgage loans that the same thing's occurring. But in this case, we're just focusing on the distressed mortgage loan. You take a hedge fund that will buy a pool of these defaulted mortgage loans. They will make contact with the borrower. Now, mind you, it may be a few years later. The person got remarried, the health got better, they got their job back, and something happened on the positive side, and they got reestablished. The borrower got reestablished. So if the hedge fund has a good operation, then they will work out payment terms with the borrower because they bought it at a discount, mind you. They may have paid 20 cents, 40 cents on the dollar for this paper. So there's room to be creative and to be compassionate. If a hedge fund operates as such, then they can create a payment plan that works with the disposable income of the borrower, and borrowers will actually be appreciative based on the relationship and based on the understanding that they'll make their payments on time. Once those payments become seasoned over time, a company like mine, which is BeQuest Funds, will go out and buy those performing mortgages in a performing state and place them in our fund, which is why we consider BeQuest Funds a low risk, high yield fund.
That leads me to my next question. How risky is note investing?
Gosh, I mean, I could answer that a few ways, but I'll say it is as risky as someone's knowledge level. What's fascinating, and I'll clarify that in just a second, but what's fascinating is that the mortgage note industry deals with money. I deal with money all day long. 10 BII calculator, calculator here, Excel spreadsheet there. Numbers all day long. However, that's actually probably, if there's a list of 10 things that are critical in the mortgage note space for success, that's probably number 8. There's so many other factors. The first, and this was in my book that I wrote 2 years ago, Note Investing Fundamentals, where I stated deal flow is king in this industry. I can't speak for other industries. I can only speak for the industry that I kind of bleed for. And that is deal flow is critical. So relationships with sellers, having a thorough underwriting process by which you vet assets, having a professionalized acquisition process where you're taking down deals and you're doing what you say 100% of the time, and then having a compassionate yet very thorough asset management division where they're making contact and they're making, striking deals and arrangements with the borrowers so that cash flow is created. So the more someone has a business set up, the more they mitigate risk. And the less they have it set up to that extent, the more that there's risky scenarios that will take place.
What is your process of finding and identifying investment opportunities?
I say with humility today, I'm going to speak to how it was a few years ago, but how it is today is that we have relationships that are so close to hedge funds, that are so close to major lending institutions, that we're fed on a regular basis. So we receive in distressed debt on a regular basis. On that side of the fence, we receive in opportunities for performing assets. Now, that may change. Nobody's taking it for granted. We're very respectful and thankful for that relationship. However, I'll speak for individuals that may not be at that point, because that's kind of best put. And I wrote about this in Note Investing Made Easier, which was my first book. And I'm not trying to plug my books. It's just what's coming to mind. But I wrote about a sourcing life cycle that needs to occur within the note space. First part of that source life cycle phase deals with identity creation. When people come in our space, and I see it quite often, they go right to, hey, I got $1 million in the bank. I'm a big real estate buy and hold guy. I'm just going to go delve into notes because I just probably have to shift a few gears and then I'll be rocking and rolling. No, identity is so critically important, yet it's so often overlooked. You need to be seen in the space as someone who is low risk, someone who's very competent, and someone who's going to perform. Because if you don't, then you're risky to me. I'm not going to do business with you if you're going to go out and do something foolish or do something, because you don't know, and then you're going to go catch me up in a bad way, some way down the road. So I have to know that you have a good process in place, that you are fully focused on this industry and you know what you're doing. So identity is about how you come off to other people, how that's perceived. And from that point, it goes into a whole marketing and branding effort, because you have the identity. Now you have to go and portray that, amplify that message to the world, to the note world. And from there, there's a daily outreach method that we employ here. Deals with CRM system. We have an outreach matrix, which gives us metrics around our outreach approach. So there's a daily sourcing effort that needs to occur when you first come in the space, and probably just needs to occur in general throughout your longevity in the space. The ultimate result is you'll see deal flow. You have to transact on the deal flow, because none of it matters if you're not transacting, because the industry is so small and tight knit that if you're not transacting, then you're dead in the water. So from a business perspective, there's someone that comes to mind, came in the business. He had $10 million liquid. He thought, hey, I'm a big gorilla. I got money in the bank. I had this successful business. Sent the message to the world, show me your deals. Number of players showed him deals. He started nitpicking because he didn't really know. He didn't have a good process set up. So he just turned people off. Nobody cares that you have $10 million in the bank. Money is so abundant in our industry. So much about your identity and so much about how professional you are from a sourcing perspective.
I like the word professionalism, and that's what you bring into the industry. What percentage of risk is imposed by foreclosure?
Foreclosure, it's really on a state-by-state basis at this point. So COVID hit and moratoriums got issued around the country. And then the CARES Act got put into effect by the Senate. So if you just take the CARES Act, from a high level perspective, it sets measures in place for borrowers being able to obtain forbearance agreements with the lenders. However, what's not stated is that the CARES Act is specific to government-backed mortgages. So when you buy mortgages in the secondary space, they're privately owned. So they're not government-backed. So actually we're exempt as an industry, as a sector, from the CARES Act. Now, with that said, we're extremely conscious of what the CARES Act's mandating, expectations, the whole PR end of it. So with that said, when a borrower calls in to us and they say, hey, we need based on COVID, we're going to ask them a series of questions, ask them to provide documentation, because we can. We found through COVID was that our collectability percentage with our performing assets all over all our entities has been about a steady 92%. So 92%, $92 of every $100 is collected on a monthly basis. Now, mind you, we purchased these at a discount. Our collective portfolio in BeQuest sits at a 61% investment to value. We have coverage. When COVID hit, we anticipated that 92% to go down to 75%. We were like, let's plan for it. We went from like a daily monitoring of our assets to like hourly. We were like on everything, code red. We were like, okay, we're going to get to 75, but how do we minimize? How do we make it 80%, which would be a victory? What we found is we were having communications with borrowers and we were asking for documentation. We found that a majority of the borrowers didn't have a COVID related need for forbearance. So it was just, they heard it in the news. a cousin told them, whatever the case. And so they just continued paying. Based on that, we maintained, we're at a 96% collected today. We were about 93% all of last year. So we were above our 92%. 90% is the industry average, industry standard rather. We've been fine from a collectability standpoint. Now, with that said, there's certain states that there are still foreclosure moratoriums in place. We have to be mindful of that. However, I'm going to say this, and because if you would ask me, hey, what are you most proud of? This would probably be that nugget. We foreclose on our distressed debt side, less than 2% of our portfolio. I'm talking mortgages that have not paid in 4 or 5 years. We foreclose. So we go through the foreclosure, take the property to auction, sell it to a third party or take it back REO, less than 2% of the time. That is insane. That is insane. And that speaks to how conscious we are and diligent we are with our team members to go and work out arrangements with the borrowers to keep in line with our mission of keeping them in their homes. That is how significant it is to us as a company. And I'll tell you this too. I know I'm like soapbox, right? I'm going to say this because it is like very passionate about this. It is sometimes more profitable to take back the property because you get instant cash flow, instant capital gains, and there's equity in the property and equity spikes in the country, so on. We are here for the cash flow, and we're here for the cash flow being paid by the borrower. You're
helping the community. I mean, that's really important.
Yeah.
What happens if the economy turns down? I mean, COVID was definitely an example of that. How do you handle that?
So when the economy, when there's a downturn, it generally means there's more supply of inventory and prices go down. Now, that's not to say like, oh, well, let me be naive. Let me, pray for a downturn, any of that. But the fact of the matter is our secondary space increases with inventory based on a market turn down. So right now we're seeing a shortage of product in our industry, and prices have skyrocketed, but that's everywhere, right? That's across all asset lines probably. But yeah, that's the anticipation. The downturn occurs and there'll just be more debt to be purchased.
What's your advice for people investing in this sector, and what do you tell them to do before they make an investment?
It depends on the investment. So if they're going to invest in themselves, start a note business and to create a better life or to create supplemental income or something to that effect, then they need to learn the fundamentals. They need to spend more time on education. There's heavy compliance in our industry. There's a lot of nuances, a lot of pitfalls, a lot of compliance. I'll just say it. It deserves saying a second time. One needs to be set up as a note business. It used to be when I started where you could be a solopreneur and be a one-person show and do it all. But those days are no more because there's too much complexity with it. There's licensed servicers you're using, there's compliance, there's licensing involved, there's debt collection courses, there's just a whole plethora of activity that's going on, and you'll never scale. And when you don't scale, you'll burn up and die. From a perspective of someone that wants to just invest, set it and forget it, then BeQuest Funds, we have a few classes. Actually, as of today, our attorney blessed the new PPM with 2 additional classes. So I'm really stoked. Before we just had an 8% return paid monthly with a 1-year lock-in period. Now we have that plus a 9% return with a 4-year lock-in period and a 6% return with a 6-month lock-in period. So we have more options for individuals. You can go park your money and just receive monthly income or let it compound at an increased interest rate. So there's a few different ways that one can invest. There's also joint venturing that goes on, but you have to be very careful because with SEC laws, I mean, to be a passive investor, investing with an active investor, if SEC could consider that a security, so that's being sold to that passive investor. So you just have to be mindful of that and have attorneys review all documents, especially as it relates to joint venturing.
Compliance is key. Do you have any advice for people that are running startups in this sector?
Yes, you should only invest in assets or start businesses that produce cash flow and that you have control over. And I learned it from doing the opposite. Control, I'll give you an example. My wife and I, when we started our federal government contracting company, we were an ant. I mean, we probably were an ant when we sold the company too later, bigger ant. However, that end customer, i.e. the Pentagon and other places we sold to, they were our customer. Now, it took us years to get there and we bled out to get the customers. They were our customers. We had control over the customer. BeQuest Funds, we get asked every week to be on someone's platform. Oh, let me get you set up on Fidelity's platform. Let me get you set up on this platform. No, thank you. We will build our own sales team and we will get to where we need to go. That customer is going to be our customer. And that's very important to us, because once you do start playing with the margins and paying fees here and there, that creates risk within our fund. And we're operating on a nice margin where we're very comfortable and we're able to recapitalize and purchase assets upon payoffs and whatnot. And so we don't want to jeopardize the safety of our fund. The other thing is that it's got to produce cash flow. So many people invest in assets for appreciation, and that's nice. But appreciation doesn't pay for groceries. It doesn't pay the mortgage.
Well said. I appreciate where you're coming from there. For your fund, what's your investment thesis? What exactly you're looking for?
I wrote another shameless plug. My apologies, Cliff. I wrote a book last year during the pandemic called Cash Flow Dojo. Build your home on multiple streams of income. The whole point of inspiration, and this is coming from someone, I have several books out. I get royalties. I mentor some people. I have hundreds of performing notes that pay me every month. So I'm coming from a place that receives hundreds of streams of income per month. My whole thesis was for the book is that, yes, people will say you can't live off a single income. That's outdated, right? That's 1970s. The husband works and the wife stays home. I'm saying that you can't live off dual income now. That's dangerous. It's not a secret for the wealthy to say, hey, you need dozens of streams of income. It's mandatory for the middle class in today's market, today's world, that you need, if you are going to provide for your family, husband, wife, whomever, you need to ensure that multiple streams of income are coming into your household. And that's the whole book. And that's what I believe with BeQuest from the bottom of my heart. It is something, I have my own money in there. My partner, Sean, has his own money. And so we launched it. We put our own money, because who am I to tell you come to BeQuest when I haven't put a penny? Sean and I put $1 million in. I mean, to kick it off. So we have money and we have skin in the game. And so that would be the other thing. Don't invest. Anybody who asks you to invest, ask them how much they've invested themselves. I think that's critical. The whole idea of one can use a fund like BeQuest to bring additional streams of income to themselves.
I think you've got a very, very good message, and I'm impressed. The idea of the multi streams of income. It's something I share with my clients on a global level. I hope our youth will look at what you're sharing at this point, because they have time value that can advance what they're looking to do. Buy your books and learn, from the knowledge. You paid your dues. You've scaled a few companies at this point in time, and you bring forth a very easy program in place, through your funds to be able to take that knowledge that's already been perfected and actually earn a very handsome return. So I want to compliment you on that.
Thank you.
What are some of the challenges that you face?
Noise. The noise out there, it's brutal. I mean, I'm here in Sarasota, Florida. In a building right across the street from the marina. It's probably the most beautiful place you could ever see. I mean, I've water in every direction. And this building's full with financial planners and financial firms. And I'm not knocking anyone. Everyone has their own angle and their own thing going on. However, I'm competing against so much noise in this industry. And I believe in my heart of hearts that, we have a good product that can help deliver cash flow to anybody who's willing to invest with us. And so I have to fight through the Apple stock is at this, the Bitcoin's at that. Yeah, it's tough.
Well, you bring something that's unique. It's consistent cash flow on a month-to-month basis, backed by real assets.
Someone told me this week it's boring, and I wanted to kiss them on the cheek.
Boring is
like,
good.
I'm like, that's us. We are boring.
How or why is keeping homeowners in their home the most profitable scenario?
Well, for one, we never modify a loan, and we never purchase a loan that's not fully amortized. So that goes to the core of my belief that the homeowner should always have an opportunity to fully pay off their home and have it owned free and clear for themselves so they can have better retirement for themselves down the road. So for one, it's just the right thing to do. I mean, we saw the, mid 2000s, all the nonsense, the ninja loans and, arms adjust after 1 year and all this nonsense, and which is what created a lot of, where we are today financially from the borrower's perspective. So the more that we are concerned or we are more considerate to what our borrower is up against, we treat our borrower as a customer. That's our mantra here. So they're treated like gold because they're paying us cash flow. They're letting us ring the register. So we need to treat them with the utmost respect. So having that focus in what is in their best interest, paying off that mortgage. Now, what happens as a result of helping them pay off their home and having it free and clear? Monthly streams of income for decades.
Perfect.
There's no other way to put it.
What are the benefits of individual notes versus a pooled note investments?
So it's a portfolio game. You're going to buy, it's kind of different when you're talking about performing mortgages, you're talking about BeQuest Funds, we can do a one-off. It uses our whole acquisition process and team to buy one loan. So we're having, economies of scale when we buy pools. So from that perspective, we always want to buy pools. We could use our system to buy one note, but it's more advantageous to focus on buying 50 notes at a time, which is a normal pool for us is like 30 to 70 loans, performing mortgages at a time. Now, from a distressed debt standpoint, you never know how the end result's going to play out. So you buy that, you haven't spoken to the homeowner in 4 or 5 years. You don't know what it is. Are they going to drag you down a long road that's going to be costly? Or are they going to go and refi you out and you'll cash out at par? You just don't know till it plays out. So buying in pools is almost mandatory from a non-performing purchase perspective.
Did the COVID cause the note buying industry to contract?
No, it's when you reference the mortgage note industry, my thought goes to supply and profitability. So from a supply standpoint, supply has been dwindling consistently over the past 5 years. So we're still good. We have access to deal flow, but on the retail side, they have bared the brunt of all this the most. There's a shortage from retail buyers that buy the one-offs, the mom and pop investors, that kind of thing. So from a supply standpoint, COVID probably accelerated it because you probably had more hedge funds that said, well, let me sit on the paper and not sell it as a fire sale and just see how it plays out. Plus equity spikes, payoffs are more prevalent in today's world. Now, from a profitability standpoint, you're paying more for the asset. However, you have more equity coverage back in the asset. So risk is minimized. So you're paying more, but you're also getting more value. So I'd say that profitability is still there. However, what COVID's done, if any, has just allowed for hedge funds to maintain deal flow upstream and not let it trickle down at the rates they did in the past.
What are you most proud of, and what will be your legacy?
To have, BeQuest Funds is a legacy play. We launched this as an evergreen fund. So to have something I can pass down to my children.
Mm-hmm. I think that's important. Are you mentoring anyone in the office at this point, young people?
Yes. We have a marketing assistant and an investor relations person. Connor, who's investor relations, he's 21, and Sophie, who works marketing, is 22. So I'm mentoring both. And I actually just had our weekly meeting this morning. We role play for our meetings, and so we do role playing exercises and on top of a lot of other different training exercises.
That's nice to give back and look after our youth. I look at it where we have a fiduciary responsibilities as our leaders to come in and put time and effort and look for opportunities to hire either new graduates, interns, and share with them, our values and what our business does, and hopefully hire, some brilliant young people to join the team and flourish, right along with us. Martin, can I share your contact information with our listeners?
Absolutely.
Martin's email is at martin@bqfunds.com, which is spelled MARTIN @BQFUNDS.com. And their website is at bqfunds.com. I want to thank our listeners. I look forward to being back with you shortly for another episode of the Private Equities Profits Podcast. The show has been produced by Market Domination, LLC.